Alright guys, so I'm going to move forward and I'm going to continue discussing about this IFRS 16. We now have got one example in front of us where we are going to talk about the lease rentals which are paid in advance. In the previous example, we talked about the lease rentals that were paid in arrears. Now we are going to talk about the lease rentals which are paid in advance. So practically speaking, this is how the case is in majority of the lease agreements, that you pay the lease agreements in advance. So like for example, if there is an example which is a lease term of 4 years, and in addition to this, if it says that the annual rentals which are paid in advance are 150,000, the guaranteed residual value is 100,000 and the discount rate is 10%. And what else is there? It says accounting entries for initial recognition, accounting entries for subsequent measurement, and you have to prepare extracts from year 1 till 4 from the SOFP and the SOCI. So you have to prepare the extracts from the statement of financial position and the statement of comprehensive income also. So that is something that you have to do. So now if I talk about it, let's just start discussing about it. So basically the first thing is that the question, again it's a basic question, a very basic, very simple question, but I think a very good question for you people to actually have a good grip over the basics of this lease accounting. So now the scenario is that the lease rentals are being paid in advance. That's what the case is. So if the lease rentals are being paid in advance, so what are going to be the timings of those lease rentals? It's going to be time period 0, it's going to be time period 1, going to be time period 2 and time period 3. So you will have 4 rentals being paid here. This is first rental, this is second rental, this is third rental, this is fourth rental. So 4 rentals are going to be paid like this, time period 0, 1, 2 and 3. Now, and at time period 4, what are we going to do? We are going to actually make a payment of what? Guaranteed residual value. So the guaranteed residual value is going to be paid at the end of year 4 because that's when it is going to be paid. That is at the end of the lease term. Now, so the first thing is that you know this thing that we have to recognize the right of use of the asset as being debited, and correspondingly we have to recognize the lease liability as credit. So how exactly are you going to recognize the right of use of the asset debit and how exactly the lease liability credit? So we would have to calculate the present value of lease liability. So you would say year, you would say cash flow or the rental, then there is this discount factor, and then there is this present value. Again, what is actually going to happen is that I'm not using the Excel right now, I'm just trying to do it manually, and the major reason for me doing manually is that there are questions in the exam where you are not given spreadsheets in that scenario, so you got to do it manually also. Now see, what happens is that your rentals are going to be paid time period 0 till time period 3. So it's 0, 1, 2 and 3. And then there is this going to be guaranteed residual value at the end of time period 4. So it's actually going to be 150,000. It's actually going to be 100,000. So you've got time period 0 till time period 3, which is 150,000, and then there is this time period 4 where this is actually going to be 100,000. Now if I talk about it, the discount factor that is given is 10%. The discount factor that is given is 10%. I'll tell you people that how exactly am I going to calculate the discount factor for time period 0 till 3. So basically what happens is that you're going to simply say that we need to have what? We need to have 3-year annuity factor. And the 3-year annuity factor at 10% is what you have to calculate. So it is going to be 2.487. Then what happens is that what you would do is that you would add year 0 PV factor, and the year 0 PV factor is going to be 1. So it would become 3.487. What is it going to become? It is going to become 3.487. So 3.487, and this is going to be 0.683, the PV factor for the time period 4, because you would have what? You would have the constant rentals being paid at 0, 1, 2 and 3. So we took 3-year PV factor, 3-year annuity factor, we added up time period 0, present value factor to it. And then there is this time period 4. So resultingly what happens is that when you're going to multiply this, it is going to become 523 028, and this is going to become 68,300. So if you sum up all of them, it is actually going to become 591,328. What are we saying? We are saying that it is going to become 591,328. So it is actually going to be what? 591,328. Now, so first of all, what are you going to do? Your recognition, the initial recognition accounting entry is going to be 591,328 ROU debit, 591,328 the lease liability credit. So you would have the right of use of the asset debit and you would have the lease liability credit. That is how the things are actually going to. So that's the first aspect, which is right of use of the asset debit. Correspondingly, the lease liability credit, that is the first aspect of it. Now, let's move a bit forward and let's discuss further. Now what we need to do is that we need to talk about the second aspect, which is the accounting entries for initial recognition is done. Now subsequent measurement needs to be done. So if I talk about the subsequent measurement is going to be like this. So if I talk about the subsequent measurement is actually going to be like this. How? Okay, Ali Akbar, if the examiner does not say anything, then it is assumed that the discount rate is the interest rate implicit in the lease. The discount rate is the interest rate implicit in the lease. Now, if we talk about it, what is actually going to happen is that the first thing that we need to understand is the depreciation that we need to charge. So you have recognized 591,328 minus 100,000 divided by 4. 591,328 is basically the cost, minus 100,000 divided by 4 is actually going to be 122,832. 122,832. So that's what the depreciation is going to be. So for each of the year 1, year 2, year 3, year 4, the accounting entries are going to be what? The accounting entries are going to be depreciation expense debited by 122,832 and the accumulated depreciation is going to be credited by 122,832. So what is actually going to happen is that the depreciation expense is going to be debited by 122,832 and the accumulated depreciation is going to be credited by 122,832. Now what is going to be the second aspect to this is actually going to be the lease amortization schedule. So what are we going to prepare? We are going to prepare the lease amortization schedule. That's going to be the second thing to it. We are going to say the date. Then what happens is that rental, finance cost, repayment, balance liability. I have not created, I repeat, I have not created a financial statement extracts right now. I'm just going to do the financial statement extracts together, but just want to tell you people that how things are going to be. Now, if I say, just for the sake of explaining to you people, I'm using a date as 1st January X1. I'm using the 1st January X1 just to explain to you people. Let's say this is 1st January X1, the starting date when we actually entered into the lease agreement. And it was $591,328. It was $591,328. Now, if I move a bit forward, I would say 31st December X1 and 1st January X2 are gonna be the same dates. Just think of them to be the same dates, which is 31st December X1, 1st January X2. Okay, sorry, before I go on to this, I actually missed out that it's an advanced rental, right? Now when it's an advanced rental, that means the day you entered into the lease, you would have to make a payment of rental. So you would have to make a payment of rental, so it's gonna be 150,000. Now you know one thing, that is basically the interest only accrues when the time passes. Interest only accrues when the time passes. So as the time passes, the interest is accrued. But over here, what is happening? The first day when you have actually obtained the asset under the lease, so what are you up to? You are actually paying the rental on the same date. So if you are paying the rental on the same date, the finance cost is going to be 0. And the entire 150,000 is going to be shown as a repayment. Now, so basically 591,328 was the opening liability, and then what happens is that the liability over here is going to be 441,328. Now, what has actually happened? What has actually happened is that the day you entered into the lease, the same day you paid the rental, so those rentals were actually offsetted against the lease liability without any allocation to the finance cost. Because no time has passed on the liability. Now, what next is going to be there? The next situation is going to be, I would say it's 31st December X1 or 1st January X2. I am intentionally writing it down. So it's going to be 150,000 here. The finance cost is going to be 10%, which is 44,133. And if it is going to be 44,133, so resultingly what happens is that $105,867 is the repayment of the lease liability minus 441,328. This actually gives you 335,461. What does it give you? It gives you 335,461. Now then what actually happens is that 31st December X2 or 1st January X3, the same thing is going to happen, 150,000. Now it is 33,546, and then it's going to be 116,454. So it's going to be 219,007. Now, this was basically time period 0, this was 0, this was 1, this was 2. Now I'm just writing time period 3. The reason being that I don't have much space to solve this scenario over here. And again, I don't want to complicate things a lot. So I'm just writing down time period 3 and I'm just writing down time period 4 here. So if I say time period 3 and time period 4, so again what would happen is that 150,000 is the rental at time period 3. And here you would say 21,901. So it is actually going to become 128,099. And this is actually going to become 90,907. Now, basically, there were supposed to be 4 rentals. So we paid at 0, we paid at 1, we paid at 2, we paid at 3. You can count them out here. We have written 4 rentals, 1, 2, 3, 4. We have written 4 rentals, it's all over rentals. Now, what is actually going to happen is that in the time period 4, which is the last year, at the start of the year, the liability is 90,907. and you know the guaranteed residual value was 100,000. So you got to make sure that it ends at 100,000. And for it to end at 100,000, this has to be what? This has to be 9093. This has to be 9093. Now, what happens is that I need to tell you something because I'm just going to connect it to the double entry also. What we do is that we use this figure, the opening liability minus the repayment gives you closing liability. So if it has to be minus, so the other number also has to be minus. Minus minus becomes plus. Now, what actually happens is that the rental is 0. So the finance cost is going to be 9093. So it's going to be 0 minus 9093 is minus 9093. 0 minus 9093 is minus 9093. And then 9907 minus 9093 gives you 100,000. So that's how things are actually going to be with respect to schedule. I'm going to pass 2-3 accounting entries because over here the 2-3 areas are a bit technical and I want you to understand them. So the first one of them is, I'm going to pass the accounting entry for 1st January X1, which is actually time period 0. So I'm simply going to say that lease liability debited by 150,000. And I'm going to say cash credited by 150,000. Because the entire amount is going to the lease liability. I repeat, the entire amount is going to the lease liability. Now second is that I'm going to come on to this, let's say 31st December X1. Because there is something which you need to understand. Now this is time period 1, this is also time period 1. 31st December X1 is at the end of year 1. 1st January X2 is the start of year 2. So start of year 2 is also end of year 1 for the present value purposes. Now you need to understand what is actually going to happen. Over here, since the rentals are paid in advance, the rentals are not paid in arrears. We are actually preparing financial statement for year end. So let's say if 31st December was your year end, what are you simply going to do? You're going to say that how much is the finance cost? It's 44,133. So all that simply you're going to do is that you're going to say so what are you going to do? You're going to simply say finance cost debited by 44,133 and you're going to say lease liability credited by 44,133. That's what you're going to do. Then because you see the year end is there, the finance cost has to be accrued, so we accrued the finance cost. Now what would happen is that when the new year would come and when you would make the rental payment, so you would simply say lease liability debit by 150,000 and correspondingly cash credited by 150,000. Now what has actually happened? What has simply happened is that we accrued the finance cost at the end of the year. Now when we are making the payment, so that payment includes the finance cost, that payment includes the repayment of loan also. But unfortunately the issue was here that we did not recognize accrued finance cost separately. We instead added it up to the lease liability, and that's how you can do, or you could accrue the finance cost, you could do both. Now I would talk about the final year entry, which is time period 4. So I would say it's 31st December X, X1, X2, X3, X4. So I'm actually passing on these entries at different time periods. I hope you people do understand this, that what am I actually up to. 0, 1, 1 and this is 4. Now what's actually going to happen, try to see this. You're simply going to do it like this. You would say that finance cost debit okay, just wait a bit. Finance cost debit by 9093 and the lease liability is credited by 9093. That's what you're going to do. Finance cost debit by 9093, lease liability credited by 9093. Why? Because what is actually happening is that your lease liability is increasing from 90907 to 100,000. It's increasing actually. And what's the reason? Because there is a finance cost that's accrued. Is that okay now? Now, do you people understand these entries? If there is any query, if there is any question on these entries, just let me know. Yeah, if anyone having any questions on these entries, just let me know, please. Okay, now again, another important aspect is that how would you prepare the financial statement? So when we talk about the financial statement preparation, the important aspect with respect to financial statement preparation is that how would the lease liability be splitted into the current and the non-current portion? How would the lease liability be splitted into the current and the non-current portion? So what I am simply going to do is that I am going to pick up this extract. I'm going to paste it here. Okay, I'm going to paste it here and I'm going to use it to show to you people that how the lease liability is going to be presented in the financial statement. So when you would have financial statement at time period 1, 2, 3 and 4, again you know this thing that your liability is to be splitted between the non-current and the current portion. So I would say non-current liability, I would say current liability. Again what happens is that it is lease liability. Now what actually happens is that there is a non-current liability, there is a current liability. What are you simply going to do? You say that I am standing right now at time period 1. So when you are standing at time period 1 is 31st December X1. Time period 1 is 31st December X1. So basically what happened was originally you had 591, you repaid 441, you repaid and you were standing at 441,328. Now at the end of year 1, your liability 441,328 is now being added up by this 44,133 being the finance cost. And in the next 12 months, this 150,000 is going to be paid. So what you're simply going to do is that you're going to say that the current liability is 150,000 and the non-current liability is going to be this 335,461. And if you want me to reconcile, I'm going to reconcile it also to you people. 335,461 plus 150,000 is going to be 485,461. Now, if you want to see, just look at this. The liability was 441,328. If you add up 44,133 being the finance cost to it, so you'll get the 441,328 plus 44,133, you'll get this 485,461. So basically when you are standing at the end of year 1, what do you have? A total accruals. Total accruals is the liability that was available at the start of the year plus plus the accrued finance cost. That's what the total accrual is. How much of this is going to be paid within next 12 months? The next year rental, which is 150,000. So what about the balance? The balance amount is going to be the lease liability, which would be what? Which would be 335,461. So for the purposes of simply applying it in the examination, you could just remember that if there is an advance rental, the rentals are shown as a current liability. The balance amount on the lease liability is shown as non-current liability. Now what's going to happen for the next one? 219,007, 150,000. What about the third one? For the third one, what is actually going to happen is that you would say the time period 2 has happened. So for the time period 2, we needed this one, so we did this one, right? Now for the time period 3, what is actually going to happen is that at the end of year 3, you would have this 90907, and this is going to be this 90907 is going to be the current liability, and at the end of the year 4, you would have 100,000 as the current liability. That's how things are going to be. Kindly look at it and let me know if this is okay to you people. Because you see, what happens is that at the end of year 1, we are standing at 335,461 total liability, but this is not the total liability. There has to be an addition of this 44,133. So basically 441,328 plus 44,133 is the total liability, of which 150,000 would be paid in the next 12 months and the balance amount would be paid after the 12 months. So basically, in case of lessee, if you get a lease rentals which are payable in arrears, how you do it, we've discussed. In case of lessee, if you get lease rentals which are paid in advance, how you do it, we have discussed that also. I'll move a bit forward and I'll discuss one more aspect which was there in the slides, but I did not discuss it earlier on, and I'm going to discuss it now just to make sure that we don't actually mess up later on. Now if you would remember the lease liability, so with respect to lease liability, we talked about fixed payment, we talked about variable payments, we talked about residual value guarantee, we talked about bargain purchase option, we talked about the penalties for termination of lease. Now there is some further discussion with respect to the lease liability, and I want you people to know with respect to this lease liability that what is that further discussion. So basically one of them is in substance fixed lease payment. In substance fixed lease payment. Let me explain to you people. We had a campus at our college. It was quite a big campus, and in our part of the world we do have an issue with the load shedding. Now for a lot of people, the load shedding was a new terminology, but I think now people living in Europe also know it, that there is a gas load shedding. The people actually know that there is going to be a situation where you know that the heaters are not going to work, things like that, because lack of power supply. So it's actually very common in our part of the world, or even in some countries which are developing countries. So it's quite common. Now anyways, so what happens is that we needed a generator, and the generator that we got, it was on a rental, and the agreement between us and the generator company was that this generator, we are going to be allowed 80 hours of usage in a month, and for every extra hour that we are going to consume, we would have to pay them Pak rupee around 2,500 for that. So that's what the agreement was between us and them. Now the area where our campus was situated, we had been operating that campus for the last 3 years, and we knew that every day there is a shortage of electricity for 4 hours, and that was during our operating hours, and we were operating 30 days a week. So if you would talk about 30 days a week, multiply by 4 hours, so it's actually 120. Now basically I have to make a fixed payment, and that fixed payment allows me to use the generator for 80 hours, and if I consume more than 80 hours, then I have to pay additional 2,500 per hour. So the day I bought the generator, I knew this thing that irrespective of whatever happens, I would have to make extra payment of 2500 into 40, which makes it 100,000. So I would have to make an extra payment of 100,000 no matter what happens. So in accordance with IFRS 16, these payments are actually in substance fixed lease payments. In substance fixed lease payments. So in substance fixed lease payments are basically which seems to be variable, but they are actually not variable. They have got a nature of being a fixed payment. They are not a variable payment. Now, let's move a bit forward. So basically, what you would do is that when you have got an in substance fixed lease payment, you would actually add it up to the lease liability calculation. That's what you would have to do. Similarly, there is something which is variable lease payment. I did explain to you that at times what happens is that your lease agreement says that the lease rentals are going to change if there is a change in the inflation index. So if your lease agreement says that the rentals are going to change if there is a change in the inflation index. So IFRS 16 says that the inflation index, like if the inflation index is 105 today at the start of the lease, and you expect that it will become 110 at the end of year 1, 115 at the end of year 2, 122 at the end of year 3, so on and so forth. You could predict, you could forecast that the inflation index is going to change at the end of year 1, 2, 3, 4. IFRS 16 says you got to ignore it. You got to just consider what it is right now. You got to just consider what it is right now. You don't have to consider what it is going to be after 3 years, after 2 years, after 4 years. Just incorporate the variable payments on the basis of what it is right now. That's it. So these are two things that you would have to keep in mind when it comes to the calculation of the lease liability. So basically, what have we done with respect to the right of use of the asset accounting? This is what the basic concepts were, and we have discussed them. In fact, we have discussed how you calculate the lease liability, how you depreciate the right of use of the asset, how do you present the right of use of asset in the balance sheet, how do you present the lease liability in the balance sheet. That is all something that we have actually discussed. Okay, I need to move forward now, and I need to discuss another aspect of the lessee accounting, which is the concept discussed in IFRS 16 about the exemption to the right of use of the asset accounting. What we have discussed till now is that how exactly is the lessee going to account for the lease. He's simply going to say right of use of the asset debit and correspondingly lease liability credit. But IFRS 16 says that there are two situations, there are two scenarios where as a lessee you could skip, this right of use of the asset accounting. Now what are those two areas where as a lessee you could skip this right of use of the asset accounting? So let me just guide you. So it says a lessee may elect not to apply the lease accounting prescribed in IFRS 16 in following cases. Number one of them is a short-term lease. The other one of them is a leases for which the underlying asset is of low value. Now, very important thing. What exactly do you mean by short-term lease? What exactly do you mean by low value asset? When we talk about a short-term lease, so the concept of short-term lease is up till 12 months. So the leases which are up till 12 months, they are going to be considered as short-term lease. I mean the leases which are for the period of less than 12 months, that is going to be considered as short-term leases. And what about the leases of low value? The low value leases are, again, what is low value? Subjective. The IFRS 16 does not say low value lease. It says it's judgmental. It depends upon company to company. It depends upon entity to entity. So like for example, if you are buying a laptop on leases, so the laptop is maybe a very small value item, right? Or maybe if you are buying something else on a lease which is a very small item which even does not meet your capitalization criteria, you could just say that it's a low value item. So what happens is that as an entity, if you could identify that the lease that you have entered into is a short-term lease, or the lease that you have entered into is of a low value item, so as an entity what you could do is that you could simply write off the rentals as an expense in the P&L no right of use of the asset needed. So simply you're gonna say P&L debit cash credit. So what are you gonna do? You're gonna simply say P&L debit cash credit. Now basically let's talk a bit further about the short-term leases. Now I'll give you a few scenarios with respect to short-term lease. First of all, I told you people that a lease that has a lease term of 12 months or less than that is gonna be considered as a short-term lease. So any lease agreement that has a lease term of 12 months or less than that is going to be considered as a short-term lease agreement. Now, in a lot of countries what happens is that the lease agreements are for a period of 12 months only. And at the end of every 12 months they are renewed and a new lease agreement is entered into. Like maybe the government regulations don't allow you to enter into a 10-year, 15-year, 20-year lease agreement. Now what actually happens is that I enter into a lease and my agreement with the lessor was that I want to continue this lease for 10 years. So he says that unfortunately our government doesn't allow us to enter into a 10-year agreement. All that we could do is that we could enter into a 12-month agreement or 11-month agreement. We cannot enter into a longer agreement. Now, so if you cannot enter into a longer agreement, so what we do is that we agree, myself and the lessor, we agree that we're going to just renew the contract every year. So there is an intention, there is an understanding, there is a mutual arrangement that the lease is for a longer term, although the agreement is only for a short term. So although the agreement is of short term, but in substance the lease is a long term lease. So you would not classify it as a short term lease. You would classify it as a normal lease and you would recognize right of use of the asset debit and lease liability credit. So what are you simply going to do? You're going to say right of use of the asset debit and you're going to say lease liability credit if in substance it's more than 12 months lease. Secondary. If a lease contains a bargain purchase option or a purchase option, so you do understand that it's just that a short term lease is there and then ultimately title is going to be transferred. So again that lease is not going to be treated as a short term lease. So you need to understand these few exceptions. So first of all, right of use of the asset accounting won't apply to a lease which is short term lease. And with respect to the short term lease classification, you need to understand this thing, that a classification of the lease as a short term, you would have to see the lease agreement in substance, that is it actually a short term, is it actually less than 12 months, is it actually a maximum of 12 months, you would have to actually evaluate it. Now similarly, the leases of low value are also going to be considered as the exemptions from the right of use. Now, what exactly is a low value lease? So it says the assessment of low value is to be made on the basis of value of an asset when it was new. So if an asset is a new asset, so its value at that time you would make an assessment. An underlying asset in a lease can be of low value only if lessee can benefit from use of the asset on its own or together with other resources that are readily available to lessee, and underlying asset is not highly dependent on or highly interrelated with other assets. So basically a low value asset is something that could be used without actually being dependent on any other asset. So like it's an isolated asset, could be used in isolation. The examples of low value leases are given: tablets, personal computers, small items, furniture, telephones, etc. Again I am telling you one thing, it's judgmental. When the IASB was preparing this IFRS, which was IFRS 16 leases, so there was an argument that we should give a value to the lease, that what is a low value lease, and the result of that argument was that no conclusion was drawn that what should be the value given, but a discussion of 5,000 euros was being made in that you could consider 5,000 euro to be a low value, but again it's not written in the standard, it's just written in the basis of conclusion that okay, this is what happened, this is what the discussion was, but it actually did not happen, right? So this is what you would have to keep in mind. Now what I am going to do is that I am going to do one example with you people so that we could have a bit of a discussion about this low value leases. So you have the example in front of you. I'm giving you 5 minutes time. You could just try to go through this whole example and classify that which one of them is a low value and which one of them is not a low value. So you've got 5 minutes. Just try to do this and then we are going to discuss it further. Okay. So I could see that you people have actually completed it. Now I'm going to start discussing this. It says identify which of the following would be classified as a low value leases. It says leases of real estate, both office and buildings. No, it won't be. It's a high value lease. Leases of manufacturing equipment. No. Leases of a company cars, both for sales personnel and senior management, and of varying quality, specs and value. So again, it's not a low value item, it's a high value item. Leases of trucks and vans used for delivery purposes of varying size and value. Again, not a low value, it's a high value item. Leases of IT equipment for use by individual employees such as laptop, computers, etc., etc. Yes, it's a low value item. Leases of servers. Servers is not low value, including many individual modules that increase that storage capacity of those. Modules have been added to mainframe servers over time as the lessee has needed to increase the storage capacity of the servers. Now, I did explain to you something. Just go back to this. It says the underlying asset in a lease can be of low value only if lessee can benefit from the use of underlying asset on its own or together with other resources that are readily available to lessee, and underlying asset is not highly dependent on or highly interrelated with other assets. So now you see what happens is that many individual modules that increase the storage capacity of those servers. The modules have been added to mainframe servers over time as the lessee has needed to increase the storage capacity. Now the servers are not low value, they are high value. The individual modules that increase the storage. So can you use the individual modules without the servers? Probably no. Probably no. They're dependent on something else. So again, these individual modules would also be not of low value. Then leases of office equipment, office furniture, yes, low value. Water dispensers, yes. High capacity photocopier device, yes, that's okay. If the photocopier device is a high capacity, again it's a photocopier device. It's not a machinery used for the manufacturing. Unless you are a printing company and it's a big printing machinery, that's a different case. So that's what the low value lease is going to be. So I could see that you people have done the right answer. There is one or two bit low answers, but I think that you people also do understand now. The ones who have classified 6 to be correct one. So 6 is also incorrect, and I have explained to people the reason why 6 is incorrect. Okay. Now there is this one final aspect with respect to the lease agreement before I go on to the accounting by lessor. So basically when we talk about the lease agreements, at times what happens is that the lease agreements that you enter into, those lease agreements have got the lease components and they've got non-lease components. Like for example, you obtain a property, a flat, an apartment on lease. Now when you get an apartment on lease, so what actually happens with that? When you have an apartment on lease, so generally speaking, the owner of the apartment has to pay some rentals to the building owners also, some maintenance cost and etc. The maintenance cost could be for the security, for the camera, for the fire alarms, for the insurance, and for the generators and the water and etc. etc. So what actually happens is that maybe you're paying a lease of, let's say, $2,000, and there is $250 that is being added to it because of the maintenance. So the lease agreement does not specifically mention that it's $250 because of that. The lease agreement says that it's $2,250. But everyone knows that this specific $250 is because of the maintenance that is being paid to the building owners, to the building management. And originally the apartment is having a lease agreement of $2,000 only. So IFRS 16, what does it say? It says that in case if you enter into an agreement where there are more than one component, so what you got to do is that you got to split them into the lease and into non-lease component. The $2,000 that you are paying is a lease component. The $250 that you are paying is a non-lease component. Now, at times what could happen is that instead of 2250, the agreement could have been for $2,150. Now what would you do in that case? So you would simply say that you would allocate this amount like this. You would say independently the standalone prices of the lease would have been what? 2150 multiplied by 2000 divided by 2250. 2150 multiplied by 250 divided by 2250. So you would have actually mentioned it like this. You would say 1911 is for this. And you would say 239 is for non-lease item. So what does IFRS 16 says? IFRS 16 says, in case if you have an agreement where there is a lease component and when there is a non-lease component. So what are you simply going to do is that you're going to split them, you're going to separate them on the basis of their standalone prices. And obviously the non-lease element has to be recognized as an expense in P&L, and the lease component would be used for the computation of the right of use of the asset. That's how you are actually going to do it. So basically by this specific thing we have actually concluded the accounting in the books of Lessee. And I hope that you people do understand this now. Okay guys. So we are now going to start with the accounting in the books of Lessor. So again there are few things which are a bit different when it comes to accounting in the books of Lessor. And I'm going to take this whole accounting in detail with you. And I'm going to explain to you people that how exactly is it going to differ. First of all, when we talk about the accounting in the books of Lessor, so the starting point of the accounting is that whatever lease agreement that you enter into, the first thing that you have to do is that you have to identify if this is an operating lease or if this is a finance lease. I repeat, the first thing that you have to do is that you have to identify if it's an operating lease agreement or if it's a finance lease agreement. Now, what exactly is a finance lease? What exactly is an operating lease? So the definition of finance lease says that a finance lease is a lease that transfers substantially all the risk and rewards incidental to ownership of an underlying asset to the lessee. So basically, if you have entered into an agreement where the risk and rewards which are incidental to the ownership of the assets are transferred to the lessee. I repeat, the risk and reward which are incidental to the ownership of the asset are transferred to the lessee, then such a lease agreement is going to be considered as a finance lease agreement. Now, generally speaking, what are the risks? Generally speaking, what are the rewards? I could write down few. Again, there could be many. But I could say the risk could be the fall in value of the asset. I could say the risk could be that the asset becoming obsolete. So, who is actually going to bear that risk? Who is actually going to bear that loss? Would decide if it's a finance lease or an operating lease. Like, if this loss is being borne by a lessee, if this loss is borne by lessee, so it is going to be considered as a finance lease agreement. Similarly, when we talk about the rewards, so again you could say that the value change, the change in the value of the asset is an indication of the rewards. I repeat, the change in the value of the asset is an indication of the rewards. So generally speaking, what happens is that you could have risk, you could have rewards. So if the risk and rewards, which are substantially all of the risk and rewards incidental to ownership of the asset, are transferred to lessee, then it is going to be considered as a finance lease agreement. And what is an operating lease agreement? So operating lease is very simple terms, that a lease agreement in which is other than finance lease is going to be operating lease. So generally speaking, what happens is that when you go for the bank finance, the bank has actually entered into a finance lease. The bank has actually entered into a finance lease. And when you go for rental of the property, so that the owner of the property has entered into an operating lease, because under the operating lease what happens is that the repair, the maintenance, the increase in value, the decrease in value, the deterioration of property, everything belongs to the owner of the property. So let me just guide you this thing, that basically what happens is that if you have entered into a bank lease where ultimately you buy the asset and you pay the installments, so ultimately that's an example of a finance lease. But if you have taken a property on lease, that's an example of a operating lease. Now, so when we talk about the accounting for lessor, the starting point for the accounting for lessor is that you have to determine if it's a finance lease or if it's an operating lease. Now, there is an additional guidance also with respect to finance lease and operating lease, and I'm going to discuss that what exactly is the additional guidance for this. So when we talk about the additional guidance for the lease classification, so IFRS 16 gives you a guidance that a lease could be categorized as a finance lease if any of the following conditions is met. If any of the following conditions is met, like the conditions which I am going to discuss now, the conditions, if any of these conditions is met, it is going to be a finance lease. Now, what are those conditions? The lease transfers the ownership of the underlying asset to the lessee by the end of lease term. So if the agreement says such that ultimately the ownership of the asset is going to be transferred to the lessee, so ultimately it is going to be a finance lease agreement. Second thing is that the lessee has the option to purchase the underlying asset at the price expected to be of sufficiently less than fair value. So you know already this thing, that we did talk about the concept of bargain purchase option. I repeat, we did talk about the concept of bargain purchase option. So when we talk about the concept of bargain purchase option, if there is an bargain purchase option in the lease agreement, it's an indication it's a finance lease. So number one of them was what? The lessee transfers the ownership. If there is a transference of the ownership, it's a finance lease. If there is a bargain purchase option existence, it's a finance lease. Third one, lease term is for the major part of the economic life of the asset. Now when we talk about the major part of the economic life of the asset, what exactly do we mean by major part of the economic life of the asset? The major part of the economic life actually means what? Major part of the economic life actually means that you could say that 75%. I could say 75%. Now what do you mean by this? For example, the useful life of the asset is 5 years. And for example, lease term is for 4 years. So technically this 4 upon 5 is 80%. And this 80% is going to be considered as a major part of the lease of the useful life. So if the lease term is for the major part of the useful life of the asset, then again it is going to be considered as a finance lease. Fourth one of them is the present value of the lease payments is substantially all of the fair value. So you know that what exactly is the lease payments. So the lease payments is simply the fixed payments, variable payments, guaranteed residual value, bargain purchase option, termination payments, etc., etc. So what do you need to do? The present value of lease payment is substantially all. What do you mean by this concept of substantially all? The substantially all actually means 90% or more. I repeat, when we talk about the word substantially all, this substantially all actually means 90% or more. So I repeat, substantially all actually means what? 90% or more. Now let me just guide you something. So if, let's say, the present value of lease payment is 900,000 and the fair value of the asset is 1 million, so resultingly this is going to be 90% or more. I repeat, resultingly it is going to be 90% or more. Do you understand this point? Resultingly it is going to be 90% or more. Now, so if the present value of the lease payments at the inception dates is substantially all of the fair value, then again it's going to be a finance lease. Lastly, the asset is of a specialized nature that no one else can use it without major modification. So again, basically what happens is that the concept of finance lease is that the asset is being purchased, that is, the asset is being used for the sole purposes of the lessee's benefits. So IFRS 16 says that these are some guidelines, these are some indications that this lease agreement could be considered as a finance lease agreement, right? How? The number one of them is the agreement says title would transfer. So if the agreement says the title would transfer, that's an indication that it's a finance lease. Number two, if there is a bargain purchase option, bargain purchase option is to purchase the asset at a lower cost, at a substantially lower cost, at a cost which no one would actually ignore, the option that no one would actually ignore. So that's actually called bargain purchase option. Third is lease term is for major part. So majority of the asset's life is being used by lessee. Number 4, the lease present value of lease payment is substantially all of fair value. And the last one of them is that the asset is of a specialized nature. So all of these 5 things are actually going to be there. So if any of these indications are there, that's an indication that it's a finance lease agreement. IFRS 16 also gives additional guidance on the lease classification. And when it comes to the additional guidance with respect to lease classification, it says that any losses on cancellation are borne by the lessee. So like for example, if the lessor has any losses, so lessee bears them. Ultimately that means lessee, the right of the ownership has been transferred to the lessee. Secondly, the gains and losses on changes in residual value accrue to lessee. Again, the asset was expected to have a residual value of 5 million, but now it's turning out to be only 100,000. Sorry, 1 million. So ultimately the loss is being borne by lessee. That means what? The risk and rewards have been transferred to lessee. Last, the lessee can continue to lease for a secondary term. Secondary term means you had an original term of 5 years plus this is allowed that 3 years more, you can take the asset on lease at a rent substantially lower than market rent. The market rent is expected to be 100,000. You are allowed to use it for 30,000. That means again, the lessor has technically transferred the risk and rewards to you. So what happens is that whenever we account for the lessor, the first thing that you have to do is that you have to identify if it's a finance lease or an operating lease. If it's a finance lease, accounting is different. If it's an operating lease, accounting is different. How would you know finance lease? Finance lease is when risk and rewards have been transferred to lessee. What are the indications? Indications are multiple and we have discussed them. Now, let's move a bit forward and let's discuss further. So before we go on to discuss the accounting for finance lease, there are few terminologies that I would want you people to understand. I repeat, there are few terminologies that I would want you people to understand. And what are those terminologies? One of them is called gross investment in lease. The other one of them is called net investment in lease. And the third one of them is unearned finance income. So these are the 3 terminologies that you would have to see. So gross investment in lease, net investment in lease and unearned finance income. Now what exactly is gross investment in lease? You know the concept of lease payments. The lease payments receivable by the lessor includes fixed payment, variable payments, guaranteed residual value, bargain purchase option, termination payment, so on and so forth. Plus any unguaranteed residual value. Now this is something extra, something new for you people, unguaranteed residual value. Now let me just guide you something that what exactly is it. For example, as a lessor you enter into a lease agreement and you tell the lessee that I want you to guarantee 100,000 for the residual value. The lessor says no, we are just gonna give you a guarantee for 70,000. So what actually happens is that this 30,000 is gonna be considered as unguaranteed residual value. I repeat, this 30,000 is gonna be considered as unguaranteed residual value. I repeat, 100,000 was the residual value that the lessor wanted to be guaranteed. Lessee says no, I'm just gonna guarantee you 70. Okay, so the balance 30 which is not guaranteed is called unguaranteed residual value. Now what exactly is this net investment in the lease? Simple, the present value of gross investment in the lease. So whatever this gross investment is, you simply discount it using interest rate implicit in the lease, you will get the net investment in the lease. More or less the accounting is similar to lessee, but the terminology is a bit different. So it's the present value of gross investment in lease. And there is something which is called unearned finance income. What is that? It's the difference between the gross investment in the lease and net investment in the lease. So like for example, what exactly is it going to be? The gross investment in the lease, let's say if it is 1 million, the net investment in the lease, which is let's say the present value of 800,000 is what it is. The difference between between them is 200,000. This is called unearned finance income. Now, what do we need to do with these? just wait a bit. First of all, try to understand the terminologies, that what is gross investment in lease, what is net investment in lease, what is unearned finance income. I have told you gross investment in the lease is the total payments. The net investment in the lease is the present value of those total payments. Unearned finance income is the difference between gross and the net investment. Now, let's move a bit forward and let's discuss further. So, what do we have? We have got an account, we have got an example over here. And what we are going to do is that we are going to use this example. We are going to try to understand this example. And then we are going to move forward. Now, what is there in this example? It says, a lessor enters into a 3-year leasing agreement commencing on 1st January 3. Under the terms of the lease, the lessee commits to pay 80,000 per annum commencing on 31st December 3. That means the rentals are receivable in arrears. That means the rentals are receivable in arrears. Now, a residual guarantee clause requires the lessee to pay 40,000 or 40,000 less the asset residual value if lower anyways. At the end of the lease term, if the lessor is unable to sell the asset for 40,000. So this 40,000 is simply your guaranteed residual value. The lessor expects to sell the asset based on current expectation for 50,000. So now you see what happens is that 50,000 is expected residual value. 40,000 is guaranteed. So generally speaking, what is going to happen is that this 10,000 is going to be unguaranteed residual value. It says the interest rate implicit in the lease is 9.2%. Present value of lease payment receivable by lessor discounted at this rate is this. Now the requirement is show the net investment in the lease from 1st January 2003 to 31st December 2 and explain what happens to the residual value guarantee on 31st December 2. Now, basically, the same accounting is going to be applied in the books of lessor that was applied in the books of lessee, but it says that there is going to be an opposite accounting. Now what exactly is this whole accounting going to be? Let me just guide you people a bit. First of all, what happens is that under this finance lease, I repeat, under this finance lease, the accounting that is going to be there in the books of lessor is going to be like this. The first thing that lessor is going to do is that he is going to de-recognize the asset, and he is going to recognize lease received. Now how exactly are we going to recognize all of this? So I'm just going to give you a bit of a guidance. I'll solve this example which was given here. I'll solve it, although the examiner has given us this 232,502. But again, what I'll do is that I will actually guide you people that how has he been able to achieve this rate. Now one thing that I want you to do is that, see, you would de-recognize the asset as a lessor, you would recognize lease receivable. Then what happens is that the lease rentals are to be splitted between finance income and recovery of lease receivable. How exactly are we going to do it? Let's just try to see this. See, the first thing is try to understand the gross investment in the lease. Gross investment in the lease is lease payment plus unguaranteed residual value. What is this lease payment? You have got 80,000 multiplied by 3 plus 40,000. This is what lease payment is. Plus the unguaranteed residual value is 10,000. So hence resultingly what is actually going to happen is that 80,000 multiplied by 3 plus 40,000 plus 10,000 gives you 290,000 as the gross investment in the lease. Now let's try to calculate the net investment in the lease. It's the present value of gross investment in the lease. Year, cash flow, discount factor, present value. Time period 1 till time period 3, there is an annual rental of 80,000. At time period 3, there is a guaranteed residual value of 40,000. At time period 3, there is a unguaranteed residual value of 10,000. So I've got 80, 40, 10. This is 9.2%. Okay, it's coming out to be 240,184. Now, he actually had it at 232,502. Now, what was it? It was actually the present value of these two items. The examiner had calculated the present value of these two items. If you would just try to calculate the present value of these two items, it is going to be 232,504. So, the amount of receivable from the lessee is going to be 232,504. But again, what we do is that we need to have the gross investment in lease, we need to have net investment in the lease, both. Now try to see. There is a third terminology which is unearned finance income, which is going to be 290,000 minus, not 232, sorry, minus 240,184. So it is gonna be 49,186. 49,186. What is it? 49,186 is the unearned finance income. What is it? Unearned finance income. Now, how exactly are we gonna do the accounting for it? Let's try to see. As a lessor, the first thing that you're gonna do is that you're gonna say lease receivable debit by 290,000. The non-current asset credited, whatever the net book value of it is. And then what happens is that you would say unearned finance income credited. How much is that going to be? 49,186. So as a lessor, your initial accounting entry is going to be lease receivable debit by 290,000, the non-current asset, whatever net book value is, and then there is going to be a gain or loss on disposal to be recognized in the P&L. So I repeat, as a lessor, you had an asset, you have to remove it, like net book value of the asset credit. Then you have to recognize lease receivable, add what? Add gross investment in the lease. Unearned finance income, and then whatever gain loss on disposal. What are you going to do next as a lessor? You would say lease amortization schedule, date, rental, finance income, recovery, balance. What are you gonna do? You're gonna say, we had dates over here also, right? It was 1st January 3. Okay. The balance amount, this lease amortization schedule would always be prepared on net investment in the lease. I repeat, the lease amortization schedule would always be prepared on the net investment in the lease. So always remember, the lease amortization schedule is going to be prepared on the net investment in the lease. How much is that? It is 240,184. Now 31st December X3, you would receive a rental of 80,000. Your finance income is going to be 22,097. So that means 57,903 is going to be the recovery. One 182281. At 31st December X4, at the end of the lease term, it has to be 51,000, because that includes the guaranteed residual value, unguaranteed residual value. Now, so what is actually going to happen is that this is how, as a lessor, you would create a lease amortization schedule. It is very similar to what we did for the lessee, but the only difference is that over here it's a finance income instead of finance cost. Now, I want you people to see how the accounting entries are going to be prepared in the books of lessor. I want you people to see that how the accounting entries are going to be prepared in the books of lessor. I've just copied the schedule again over here just to make sure that you can see it simultaneously while passing the entries. Now see, there is something that you need to understand with respect to it. What happens is that at 31st December 3, on the basis of this schedule, the simple entry is going to be cash debit by 80,000. Finance income credited by 22,097. And lease receivable credited by 57,903. The simple entry should have been like this, but it is not done this way in the books of lessor. Although you do prepare the lease amortization schedule on the basis of net investment in the lease, but you don't pass the double entry like this. The double entries are passed like this. Let me just guide you. You would say cash debit by 80,000. Lease receivable credited by 80,000. Why? Because the lease receivable was originally recorded at gross investment in the lease. It was not recorded at net investment in the lease. number one. Then what you would do is that you would say unearned finance income debit by 22097, finance income credit by 22097. Now technically what has happened because of this entry is that I just need to show you people gross investment in the lease, unearned finance income, net investment in the lease. Let me just guide you people so that you do understand. Opening, how much was it? Gross investment 290,000, right? The unearned finance income opening was 49,186. If you determine the difference between these two, you will end up getting 240,184. Now, what actually happens is that the movement over here is 80,000. So it will be like 210,000 at the end of the year. The movement over here is 27,089. Now you calculate the difference between these two. You will end up getting 182,911. Now, $22,097 is 57,903 minus 240,184. 182,281. 182,281. This is okay, right? Now, how much is it? 210,000 minus 27,089. Okay, there is just some rounding off issue probably where I'm actually making some error, but just trying to tell you people that what happens is that every now and then your unearned finance income keeps on transferring into finance income, your gross investment in the lease keeps on decreasing, and end of the day you keep on standing at what? You keep on standing at the net investment in the lease. So basically in the books of lessor, this is how it is going to be if it's a finance lease agreement. So what is it that you need to do? You need to de-recognize the asset, you need to recognize the lease receivable, and correspondingly that's how things are going to move. So basically from the books of lessor, this is how the accounting is going to be for the finance lease. Now there are further aspects which is manufacturer, dealer, lessor and operating lease from the perspective of the lessor, which we need to discuss and which we are going to discuss, but for the time being, right now what I have actually concluded is I've gone through the accounting in the books of lessor and I've given you that what is it that how is the finance lease classified and how does the lessor accounts for a finance lease. That is what I've explained to you people, and I hope that you people would have actually understood this. So now I'm actually going to open the floor for you people to ask the question. You can ask as many questions as you have and I'll be happy to answer.